you don't know how to read charts properly, nothing else in your trading journey will matter. You can know all the risk management in the world, but if you can't read what these candlesticks are trying to tell you, you'll never be consistent. The truth is, every move the market makes leaves a story behind. And that story is written in wicks. Those long Exhaustion wicks, those clean wick fills, and those exhaustion wicks at key levels, they all reveals where traders are trapped and where the next move is likely to go. In this video, I'm going to break down exactly how I analyze charts from the higher time frames all the way down to entries, using nothing but pure price action, and how I use Wick Fills and Exhaustion Wicks to predict explosive moves. So watch until the end, because if you can't handle a few minutes of learning, you're not ready for years of grinding. By the way, I just launched my exact cheat code to get in fanatic for just $10, and I'll be giving away $50,000, 10 accounts. Click the link in the description for the full details to participate in the giveaway. Alright, let's get into it. Okay, now, what is a Wick Fill? Let's talk about Wick Fills first. One of my favorite concepts in technical analysis. I'll keep this super simple so you never look at a candle the same way ever again. Let's say we're looking at a daily candle that's coming up from a support and it closed bullish. That tells us there's momentum. And if that daily candle has a wick to the, let's say, upside, there's now a high probability that the next daily candle might continue up to fill that wick. Now GJ, the pay I trade, usually has large wicks because of its volatility. So daily wick might be, let's say, 30 to 40 pips long. That means if I'm not trading the daily chart, I can go down to the 4 hour and look for an opportunity to catch that move as it fills the wick on the higher time frame. Okay, this is how it works. On the 4 hour, I usually see stretcher from me. Maybe let's say a support at the bottom where the daily candles low is. You get a couple of bullish candles from that support, showing that buyers are stepping in. Now when the next daily candle opens, it might wick down fast, creating a bottom wick, and then start pushing up. That's your moment, because as that daily candle pushes up, it's not just random movement. It's literally the small time frames executing the Wick Fill. So your goal as a trader is to time that. You can take your entry when the 4 hour or even 1 hour candle forms a support and starts closing bullish. Okay, it starts closing bullish. Your stop loss goes right below that previous candle's low, and your target becomes the previous high. Okay, previous candle high, the wick you're expecting to be filled. So what's happening here is simple but powerful. As price moves up and breaks stretcher on the lower time frames, it's simultaneously filling the wick on the higher time frame. That's what we call the Wick Fill. And the best part is it's clean, it's logical, and it happened again and again, especially when volume kicks in. Alright, now let's talk about Exhaustion Wicks. This is something most traders overlook, but if you learn how to spot them properly, it literally tells you when the market is getting tired and about to retrace or reverse. So here's the thing. A wick fill shows the direction that the market wants to go, but an exhaustion wick shows when that direction is running out of strength. Let me explain. Whenever you see a candle with a big wick and a small body, that's your first clue. That means price tried to push in one direction but completely rejected that move before the candle closed. And when the wick is bigger than the body, that's a clear sign that volume is slowing down and the market is literally taking a breath. For example, imagine let's say an uptrend. Okay, candles are pushing higher, full body bullish candles. Then suddenly you get a small body bullish candle with a long top wick. That's your exhaustion. It tells you that buyers are no longer as strong as before. So instead of buying that candle, you should be thinking, okay, I might get a retracement soon. And that's exactly what you want to wait for. A retracement, a small pullback, and then a new support to form before you look for another buy. Okay? The same thing works in a downtrend. You'll see full body bearish candles one after another, then suddenly a small body bearish candle with a long bottom wick. That's your sign that sellers are getting exhausted. And you can see a short-term retracement or even a reversal. Now, one thing you've got to remember Exhaustion Wicks are most reliable on higher intraday time frames like the 30 minutes, 1 hour, or 4 hour. Anything below 30 minutes, like 15 minutes or 5 minutes, those wicks can fake you out easily because of noise and low volume spikes. So I personally focus on exhaustion signs from 30 minutes and above for more accurate confirmation. And here's a tip. The moment you spot an exhaustion wick, don't rush. Okay, wait for the next candle to form a stretcher. If it forms supports, let's say in an uptrend, that's your confirmation to buy continuation. If it forms resistance in a downtrend, that's your confirmation to continue selling. Okay, you'll be shocked at how much this one small detail, recognizing exhaustion, can improve your entry. So yeah, exhaustion wicks are basically the market's way of whispering, hey, chill out, I'm about to pull back for a bit. Once you learn to listen to that, your timing becomes way sharper. So whenever most people open up a chart, this is usually what they do. They start drawing random trend lines, connecting highs and lows, and saying things like, okay, maybe we're gonna go up from here, maybe we'll drop down from here. And honestly, it's not that this never works, it's just not consistent. My favorite way to analyze charts is way simpler and way more structured. So before anything, we're gonna clean all this mess up. No unnecessary lines, no random drawings, just pure price action. Now I always start from the daily time frame. Okay, I want to understand what the overall story is. I look at the candles, their bodies, their wicks, because that's where the truth is. If I can't read what the candles are saying, I have no idea where price is heading next. So the first thing I notice is that we have formed a support. The daily candle came down, rejected that area. Okay, this is rejecting and closed back above it, meaning buyers are stepping in. That tells me we're in a potential reaction zone. Now, when we talk about trends, it's all relative to the time frame you're looking at. If you're on the 1 hour time frame and you think price will go up, that's your short-term trend. If you're on the 4 hour and it looks bearish, that's your mid-term trend. Some people might be arguing this is an uptrend on the 4 hour, this is a downtrend on the 1 hour, this is ranging on the 50-minute chart. Come on, bro. There's no single right trend. That depends on your perspective. So let's drop to the 4 hour chart. Now we can refine our zones. That daily support might not be perfectly aligned here. So I'll just adjust it, make a 4 hour support and a 4 hour resistance. Now the chart starts to make sense. You'll notice we're kind of consolidating in between, maybe a 60 pips range from support to resistance. So the question is, are we targeting the closer resistance or the one higher up? The safer bet is usually the nearer zone. Now let's drop to the 1 hour time frame and start refining the chart. You can see our previous zone is overlapping with the candles right here. So the first thing we need to do is adjust it. Okay, let's adjust it. A lot of people ask me, shouldn't the zone be thicker? Shouldn't it cover the wider area? And the answer is no. Here's why. Your zone should always be based on where candles are closing, not just where they wick. If you notice most candle bodies closing around, that's your key level. That's where you want to see future candles reacting. Okay, so instead of drawing a fat box that confuses you, keep your zone thin and clean. Just enough to represent the actual price area where candles close. That's all you need. Now imagine this. We've had multiple candles rejecting 2383, 1, 2, 3, 4, maybe 5 rejections from that same price level. That's clear evidence that buyers are defending this area. Okay, this is defending this area, as you can see. So if we now see a candle finally closing below support, what does that tell us? It means the buyers were defending that level are gone. Now there's a high probability price will move bearish. That's the key. We are always trading based on probability, not prediction like this is going to go up, this is going to go down. I thought, no. If the candle closes below a level, that's been respected multiple times. We simply follow the probability that the market will continue in that direction. And this is why keeping your zones thin and precise matters. Because if your zone is too thick, you'll be second guessing yourself. Do I enter now? Do I wait for another candle? And that hesitation kills clarity. Now I know exactly how I do my analysis, but watching isn't enough. If you can't put in the hours to study your charts, none of this matters. Before the next video, I want you to open at least 10 different charts and see examples of Wick Fills and Exhaustion Wicks and study it. Do that and you'll be ahead of 90% of traders. I'll see you in the next video. Ciao, ciao.